Good morning, everyone. Thank you so much for joining our Phillip Security Research 11 o'clock Monday morning call. Today we have a couple of macro sector update, including banking and air transport monthly, software quarterly, Singapore weekly, and also tanker polls. In addition, we also have YZJ Maritime Development Initiation and also first REIT update. So, for disclaimer, the information provided in this seminar is solely for educational purposes and it should not be considered as a financial advice. So, please seek advice from a financial advisor before making any investment decision. Next, I'll pass the time to Fahmi. Thanks very much.
Hi, thank you, Serena. Hi, everyone. So I'm presenting on the US software quarterly. So the theme is that the fundamentals remain intact. Fundamentals is referring to the metric like revenue and also the net margin. Thank you. So first of all, the market has priced slower growth for the software industry, but we do think that the pricing is being done indiscriminately. So you see the sector ETF, which is IGV, which is our indication for how software is performing, has been down 24% year to date. So the current fall is the fourth largest yet to date. Yet it is behind the dot-com bubble, 63% global financial crisis, and also the post-COVID tech sell-off. But what we see is that the software fundamentals remain intact. If you look at the total sales on the left chart, that the software total growth has re-accelerated since the mid of 2023. And this total revenue is re-extracted from 112 companies. So it's quite a holistic view. So it's trending higher, it's growing at 16% year over year in the recent quarter of fourth quarter 2025. And it is the highest in the last 3 years, the growth rate. But since we want to look at the pure software performance, if you exclude the cloud providers such as Microsoft and Oracle from the line chart, we could still see that the software industry is growing at 15% year over year. It's just a bit lower than the when you exclude the hyperscalers and when you exclude the cloud providers. And we expect this growth rate to remain steady at 16% year over year in the next quarter. And what particular that we observe is that also the large cap, which is the companies with market cap larger than 10 billion US dollar, from your right chart, which we took from 34 constituent companies, is performing better than the smaller caps in the software industry amid the AI disruptions. The revenue is growing at 17% year over year, larger than 12% in the same quarter last year. And we do think that these numbers, the growth rate would remain at 17% in the next quarter, even amidst what we read in the news, AI amid disruption, for the reason that we believe is going to perform well. The large cap is performing 7% higher than the smaller cap. You see the dark blue line chart is higher than the orange line chart. And also, next slide, please. Thank you. That the large cap is consistently in profit compared to the smaller cap and still trending higher. Looking at the valuation, currently, specifically the large cap software is trading at -1 standard deviation at 9.4. The enterprise value over sales ratio for the large cap SaaS is currently at 9, below the 9.4, and it's approaching the previous low of 7.72 in the previous tech sell-off post-COVID-19 in the third quarter of 2022. But despite the lower valuation, if you look at the previously presented information where the revenue is still rising and the net income is still performing better, we do think that it's like an opportunity for you in the SaaS industry. And next slide, please. This is for the outlook. What we are seeing right now, first, is that most of the large cap companies, like the one that we covered, like Microsoft, Salesforce, Adobe, is currently prioritizing AI usage codes over the aggressively upselling that premium package. There's clear AI monetization rules where many of them have integrated AI models into their more premium SKU, which is stock keeping unit, more premium package of selling. And also they have presented generative credit consumption usage-based pricing, which is other than the subscription usage that they usually did. So there's improvement there. And also the monetization is further slow, but we do think that they are focusing on the volume first, like increase the usage first instead of right way monetization quickly, because it's still, the amount is still immaterial. Then the second, what we are seeing is that the companies, software companies, have quickly adapted. By what they did is that they're partnering with the AI models. You read from the news, they partner with the ChatGPT, they have models, they partner with the Anthropic and all that. And whenever newer models came out, they just quickly integrate into their software platform. So the rumor where the AI startup and DIY could be done, it's like we do think that since they could quickly adapt to the newer models, we think that they are quite resilient to just what you see out there. We do think that it would remain resilient. But since they are now adopting a new generative credit consumption model pricing, we do expect some revenue and earnings fluctuation from these newer models. Still, subscription will still dominate the pricing since it's making up 80% of the revenue and earnings. But it's also an opportunity for them. Now that they are using consumption-based pricing, it would allow them to unlock upside. As customers find more value, they will pay more instead of just being limited to the subscription. And lastly, we think that while the growth may slow in the near future, because the market is just pricing based on terminal value of what they see or what they think in the near future. But what we see in the near term, the slide information will show you that the near term fundamentals remain intact. So we believe traditional software will remain resilient against the generative AI and startup competitors. They have been long in the industry, they have the expertise, they have the regulatory compliance that they have been adhering for the last 10 years, something like that. So, and they could also, most important, quickly embed AI agents as newer models become available, and always try to give to the enterprises at a lower price. Next slide, please. So this is the software key financials, including the company that we covered. Just a quick look into the company that we cover. Microsoft is 17% year-over-year growth, still quite good. And the PATMI rose 23%. So we still see strong long-term earnings visibility for Microsoft, especially from the cloud and AI. The RPO backlog grew 110% coming from the OpenAI, and the demand is exceeding Azure capacity. We think that there's likely chances that OpenAI could commit to what they asked from Microsoft Cloud as this thing. From what we researched, we think that the cash inflow in the 2026 is sufficient to pay the commitment that they would likely have to pay by 2027, coming out from the capital market mainly. So they would survive based on the capital market, such as private capital raise that they have done in this year, recently ahead 22 billion US dollar, and although revenue is going to quickly grow, but it wouldn't be large enough to get there. But then again, net we do think they have sufficient amount to pay the OpenAI have enough money to pay the commitment to Microsoft and Oracle as well. So that's for Microsoft. Since we're talking about the Microsoft, the OpenAI same is for Oracle's, because they are also the hyperscaler player. The construction with the Stargate AI campus in Albion, Texas is already in a good track. There's 2 of the data centers is already operational. The 8 data centers should be completed by the mid-year of 2026 and already running the Oracle OCI workload. So also the OpenAI, we do think OpenAI could pay the commitment to Oracle's by 2027, since when they would have to start paying the commitment, which is starting in 2027. We expect easing in capital expenditure and the free cash flow coming from the new funding models that they introduced, where the customers, instead of Oracle themselves spending their own capital expenditure upfront, whenever a new customer coming from the cloud providers, the customer themselves would have to bring their own hardware. Also, they have to pay their upfront payments in order to run their clouds upfront. So that's going to ease their capital expenditure moving forward. And also the raise, 45 billion US capital raise, would support the 2026 capex at 50 billion this year. And the bond that they raised, which would mature by 2029, we think that they are able to pay it at 5% yield, which is manageable, because by 2029, we think the operating income would grow 48% year-over-year in the same year. So we do think that they could pay off the bond principal in that year. So that's for Microsoft and Oracle. Next is for Adobe. The story is that there's high usage for the creative usage. So that's positive. very high usage of creative products, but we do see that the annualized recurring revenue, which is their monetization, is just flat year over year. But we do think that this will be continued sharp rise in monthly active users, especially coming from the generative credit that they would have. Also for Palante, 70% year-over-year growth in the recent quarter, coming from US commercial revenue rose 137% year-over-year exponentially. This would be supported and to be continued supported by the expanding deal sizes and customer accelerated conversion coming from the bootcamp that they did in AIP, even recently in the AIP Bootcamp 9. We remain positive on Palante as they would have the ontology mode and the AIP tools would drive faster enterprise AI adoption just beyond the defense industry. Yes, so I think that's all for the company that we covered. Next slide, please. So this is the recommendation that we have for the software industry, including the company that we covered. Yeah. I think that is all for me. I will pass over to the next presenter. Thank you.
Hey, thanks, Hami. Yeah, so we'll be covering the banking monthly first before going to YZJ Maritime. So for the banking monthly, next slide, please. Yeah, we are seeing that the 3-month SORA is actually at the lowest in 45 months. So if you look at the date, it's since July 2022, so almost 4 years. And it fell by a further 5 basis points month on month to 1.09%. Year on year, it fell by 153 basis points. But if you look at the year-on-year decline, this is the smallest year-on-year decline in 9 months. So we are seeing somewhat, some form of stabilization. If you look at the green line here, for compared against the first quarter average, it was 4 basis points lower, and the average was 1.13%. So we believe that the continued surge in capital inflows, has driven interest rates sharply lower, but we do expect that the decline will taper off for the rest of the year as expectations of rate cuts have been lowered due to the Middle East conflict. In terms of the HIBOR, it also declined. It fell for the 5th consecutive month in March by 28 basis points month on month to 2.41%. And it's also 25 basis points lower than the first quarter average of 2.66%. Moving on to the next slide, we'll be looking at the loans growth. Yeah, so for loans growth, it's still holding steady above 6%, very healthy figures and numbers. We saw that it was up by 6.3% year on year in February, and this was higher than the previous month's growth of 6.1%. We still expect mid-single digits growth in 2026, mainly from the very low interest rates that we have seen. And yeah, but what might actually affect this would be the Middle East conflict. While it could also push the rates back, or like the rates will remain higher for longer, and also it could impact some of the sectors where the loans are coming from. The banks are still guiding for mid-single digit loans growth in 2026. Business loans were up by 5% year on year, where mainly coming from the building and construction segment, and the consumer loans were up by 8%, where we are seeing the housing loans actually up by 6% year on year. Yeah, sorry, I think this, not sure if anyone else is hearing echo, because someone just said there is echo for both Fahmi and myself. Yeah, moving on, maybe let me speak a bit louder a bit. Yeah, next slide, please. Yeah, looking at the deposits and balances, we saw deposits continue to rise. It was up by 5% year on year in February. But more importantly, and what we always look at would be the current account and savings accounts ratio, or CASA. And why we believe this is very important, or why it's very important for the banks, is because it represents the lowest cost of funds for the banks. So if the ratio is higher, it means that it's more beneficial for the banks, because then they can reduce their cost of funds, and this will help to improve their margins. So we saw some positive figures in February. It was up to the ratio was up to 20% compared to the previous month of 19.8%, and this is the highest that we have seen the CASA ratio in 3 years. It also grew by the 11% year on year. We continue to expect that the CASA ratio will rise, mainly because of a lot of higher interest fixed deposits mature and the funds are shifted and placed and kept back into CASA. Now, moving on to the next slide, we'll be looking at the volume growth. Yeah, so SGX statistics, the volume growth has been very positive as well, mainly from the heightened volatility. So in March, we saw that preliminary SDAV was up by or surging by 56% year on year, and the DDAV, was up by 22% in February. So the main reason why is this is mainly, of course, due to the Middle East and Iran conflict, where it affected or hiked the VIX, which is the market index that we use to measure the implied volatility of the S&P 500. It was up to 25.6 in March, much higher than the February's level of 19.1. And we believe that this heightened volatility could continue to persist into the rest of the year, with really not much sign of the Middle East conflict coming to an end. And this will help to benefit both the SDAV and DDAV. And bottom line, it will also help to improve SGX volume growth, and this will improve their bottom line as well. So for the top 4 equity index futures turnover, it was up by 18% year on year, mainly due to an increase in the FTSE China A50 and the FTSE Taiwan index futures. Moving on to the next slide, we're looking at the Singapore Bank's performance. So we saw a slight recovery in the bank's share price performance in March. It was up by close to 1%, partially reversing some of the decline that we saw in February, down by 2% in February. And this increase was really led by OCBC, was up by 3%, whereas DBS was largely flat, and UOB did lag slightly, down by about 0.7%. So the increase that we believe was driven by the repricing of interest rate expectations, mainly with now the markets pricing in almost no rate cuts for the rest of the year. And this helped to present a very NIM supportive backdrop. The banks have also benefited quite a bit from the defensive rotation, from out of the rate sensitive property developers and REITs into banks, and because banks tend to gain more from a higher for longer rate environment. Now, moving on to the next slide, we did do, since there's so much talk on, the Middle East and Iran conflict, how does it actually impact the Singapore banks? So we did do this, pull out some data, on the sectors that are impacted the most by the Middle East conflict. So firstly will be the transport, storage and communication sector, or TSC for short. This is where the oil and gas loans are actually nested in, but they don't give specific oil and gas breakdown. But this bigger group of the TSC loans only account for around 7% of the 3 banks, and aggregate around 7%. So it's very small, and also the sector NPL ratios are also quite benign. UOB and OCBC's NPLs for this sector is only like 0.5% and 0.3%, whereas DBS's one is slightly higher, but it has improved year on year, from 2.7% a year ago to 2% in the fourth quarter of 2025. And another sector that we look at would be the ASEAN loans growth, or the emerging. We use that as a gauge for the emerging markets. So it has been relatively stable and quite slow. So it's only averaged at around low to mid single digits. So we believe that there's no aggressive build-up, that would actually amplify the emerging market risk. So, you combine also with the ample provisioning buffers that all 3 banks have. DBS is like 130%, OCBC 150%, and now UOB is just slightly below 100%. And all 3 banks' credit costs are expected to also remain within their guidance. We believe that this conflict will unlikely to pose a material credit risk to the sector, at least not any direct risk. Yeah. So now moving on to the next slide. Yeah, so to conclude, we believe that the escalation of the Iran crisis and oil prices, surging past the $100 mark, the US $100 mark, has pushed the Feds to raise their inflation forecast, and this is now everyone is pricing in almost no rate cuts for the rest of the year. And this higher for longer rate backdrop is very supportive for the banks, especially for their margins and their interest income. And we have actually seen this Q-on-Q NIM stabilization happening already with OCBC and UOB in the fourth quarter. And the heightened market volatility has also continued to benefit capital markets income and wealth management fees. And this will help to provide a meaningful offset to the net interest income headwinds that the banks could possibly face. Yeah, so we do maintain neutral for the banking sector. So that's for the banking monthly. Now let me move on to the initiation. We initiate coverage on YZJ Maritime development. So we just move on straight to the business model first before we go to our investment merits. Yeah, so for business, why we're going through the business model first is just to give an explanation or to explain what is the business model of the company, because it might not be widely known, or people don't really know what they actually do. So what YZJ Maritime does is that they operate as a one-stop platform for maritime financial solutions. So they're not really a traditional ship owner, where they just own and operate vessels. They're also not a bank, that only provide loans. They actually connect all the participants in the ecosystem of the maritime, so it goes across shipyards, ship owners, charterers, capital markets, and they help to create and capture value at every stage. So their platform model, they work as a maritime investment platform where they raise and deploy capital into shipping assets, and then they earn returns through a combination of different income streams. So you look at this chart here, you can actually see how they have performed this platform, how they are this platform where they connect shipyards, capital markets, ship owners, and charterers. Now, moving on to the next slide, we're looking at the three ways that the group makes money, right? So they deploy capital across three distinct activities, and each of them actually target different risk return profiles. So investments, which make up about a bit less than half, so 40 to 45% of their funds, where their returns are capital gains plus charter income. They order new builds at about 20% below market, and then they will pre-sell them for capital gains or charter for recurring income. Then the next one would be the financing, where it makes up similar to the investments, around 40 to 45% of the fund. It's mainly a sale and leaseback model, and their returns are recurring lease interest. And last but not least, we have the value-added services. So this is the smallest portion. It's only about 10 to 20% of the fund, where they do ship chartering, brokering, and import-export. So the returns from this are the chartering margin spread. So another one would be moving on to the vessel life cycle. I mentioned that the group earns at every stage. So a key differentiator to the company is that their ability to participate across the full life cycle of a vessel. So this is actually one of the key investment merits that we have. But this flow will basically illustrate how a single vessel investment can generate multiple income streams over its lifetime. So it's all the way from stage one, which is new building, and then you have delivery, operation, financing, and exit. Yeah, so this will help to better showcase how the group makes at every stage of a vessel life cycle. Now, moving on to the next slide, we have the financing model. So the financing model is the sale and leaseback structure I mentioned earlier. So a significant portion of their income comes from maritime financing, and it's structured primarily as a sale and leaseback transaction. The simple explanation on this is that the ship owner will sell their vessel to YZJ Maritime at an agreed price, and then they will immediately lease it back for a fixed period. So this will continue, and they will continue to operate the vessel as before, as in the ship owner. So the company will then earn recurring interest income from this lease, while the vessel itself will serve as a collateral, which helps to provide a downside protection. And we believe that this asset-light approach will give four key advantages. Right? The first one being that the diversified income streams across the charter, lease, and capital gains, they reduce dependence on any single revenue source. Secondly, the asset-backed nature of the financing, where the vessels act as collateral, provides a downside protection. Thirdly, the integrated platform creates access to a proprietary deal pipeline that standalone ship owners or pure financiers cannot sort of replicate this. And the last one is that they target unleveraged project IRRs of around 10 to 15% and the potential to reach 20 to 30% through leverage. So now, all that being said, we'll go back to the investment merits and why we initiated coverage with a buy recommendation on YZJ Maritime development. The first one, I said earlier, it was the full life cycle capture across all vessel types. So they are able to capture value at every stage, right? Where they get procurement margins at build, charter income during operation, interest on finance leases, and also capital gains on exit. And this is not just across one type of vessel, right? It's across a whole fleet of tankers, gas carriers, bulkers, container ships, and OSVs. So they currently have around 80 plus vessels and up to 50 new builds in the pipeline. The second one we'll be looking at would be the shipping cycle upswing, which helps to accelerate the transition from just a pure cash management company into a maritime business. So they are constantly deploying cash into maritime assets at an inflection point where we are seeing vessel prices at 15-year highs. They're up by around 95% year on year. And the cash management income for YZJ Maritime did fall by 56% year on year. while the maritime business income surged by 61%. So we are seeing this shift from cash management into the maritime business. And now the maritime business does contribute 49% to their total income, and this is up from 29% in FY24. So we will continue to see this shift into the maritime business where more cash is placed back into the maritime fund. They currently have $1.3 billion across two funds and the 50 vessel new building pipeline, and also the Baltic Dry Index, which is what we use to measure, like the vessel prices. It's at 2,000 currently, so it's up by 22% year on year. We believe that the transition into this maritime business has very significant runway. And next slide. So the last investment merit that we have is that they have a net cash balance sheet at 27% of their market cap. So they hold around $400 million in cash. They have zero borrowings and also total liabilities of just 3.1% of total assets. Majority of their financial assets are actually at level 2 and level 3, and their net cash of 507 million Sing dollars represents 27% of the market cap. So this is more than a quarter of the share price is backed by cash alone. We believe that this unleveraged position embeds very significant upside optionality because the management does plan to introduce leverage, in the form of bank borrowings, convertible notes, or asset-backed loans, and this could help to boost their project IRRs from the current 10 to 15% to 20 to 30%. We initiate coverage with a buy rating and a target price of 69 cents. Our target price is pegged to 1 times price over book, and this is 11% above the peer valuations of around 0.9 times. So we believe that this slight premium of 11% is warranted, given the group's net cash of $507 million, which is 27% of their market cap, the rapid book value growth trajectory. So we are seeing that net assets have increased from 500 million to 2 billion in just over 3 years, and also the differentiated positioning as a full life cycle maritime financial platform rather than just a pure vessel operator. And there's also an upside to the book value from the rising earnings and also the unrealized gains in the 50 plus new builds that they have on hand. So that's all I have for Yang Zhejiang, and I think that's all for me. I'll now hand it over to Darren for First REIT. Thanks.
Yeah, thanks, Glenn. Yeah, let me run through First REIT's proposed divestment of all their Indonesian assets. Yeah, so for First REIT, they plan to divest their Indonesian assets in 2 tranches. So the first tranche is 8 hospital assets for about 400 million, and another 3 non-hospital assets for about 82 million. So the 8 hospital assets will be sold to Siloam, while 2 of the 3 non-hospital assets will be sold to Lippo Karawaci, and the last one is structured as a prepaid lease to MPU. So in connection with the divestments, the rental arrears from MPU of about 6.9 million, so that will be fully repaid. And altogether, the 8 hospitals and the 3 non-hospital assets, together the value is about the total consideration about 470 million. So that is about 2.1% premium over the average of the latest 2 independent valuations. So the hospitals 8 assets were about at a 2.8% premium, and the 3 non-hospital assets were about a 1% discount. Yeah, so that's for the first tranche of the divestment. So for the next tranche that they plan to divest by 31st October, so they have a put option to divest the remaining 6 Indonesian hospitals to Siloam for about 300 million. So Siloam, on the other side, they do not have the option, they do not have the corresponding call option to purchase, so only First REIT has the right to sell. Yeah, and the completion of the put option is dependent on several conditions, so including the completion of the first tranche of divestments and, of course, the unitholders' approval. So for the first tranche of divestment, there will be a EGM. So the EGM is currently scheduled for June 2026, with the target completion of the first tranche of divestments in August. And then First REIT will likely, after the completion of that first tranche, they will likely exercise the put option to sell the remaining 6 Indonesian hospitals to Siloam afterwards. Yeah, so why they are doing it in 2 tranches? Because basically they want to maximize the value as well as to provide DPU stability. Because if they sell all the assets one shot, that will be about 88% loss. Because the Indonesian portfolio is about 88% of the portfolio. So if one shot they just sell this 88%, then basically the REIT become like a cash rich and it probably like a spec. So yeah, they do it at two tranche. And while they do this two tranche way, they also basically delay the time because right now they are trying to search for redeployment opportunities in developed markets. So while delaying, they have more time to basically carry on their strategic review and identify more opportunities in these developed markets in the APAC region. Yeah, so we maintain our accumulate call, but our target price we changed from a dividend discount model to a one-time price at NAV because basically after the divestment of these eight hospital assets, they will not have any income from this Indonesia, and basically they'll just have the Japan and Singapore properties left. So we change it to one-time price at NAV, so that's 25 cents. So yeah, that's mainly from the uncertainty of the future portfolio composition after they divest the Indonesian assets, as so far no assets has been earmarked for any acquisition. Yeah, next slide, please. Yeah, so just more details on this deal. So as part of this deal, the manager is entitled to about 2.4 million of divestment fees, but in this situation they will waive these 2.4 million divestment fees to align with unitholders' interest. And also this 2.1% premium for the first tranche that translates to about roughly 9.7 million premium. So firstly, they have indicated and they're fully committed to pay out this premium over appraised value as special dividends over the 2 quarters following completion. So they're very committed to that. And if you look on a pro forma basis, assuming this all the assets were divested from the FY20 at the start of FY25, the DPU would have been 1.39 cents instead of 2.17 cents that were reported. And if we include the special dividends, it will be 1.85 cents. So the aggregate leverage also after this deal will decline to about 16.7%. So FY25's aggregate leverage was 42.1%. So we did some rough calculations. So assuming that the first tranche completes the divestment in August, the FY26 DPU will likely drop to about 1.7 cents from our original estimate of about 2.27 cents. Yeah, so how firstly they plan to use the proceeds. So after all the divestment costs and associated costs, the aggregate net proceeds, they'll use it primarily to pay down debt. So that's about 78% to pay down debt and 2.1% committed to unit holders as special distributions. Yeah, and basically the remaining they'll hold as cash and allocate to CapEx or working capital. Yeah, but after they pay down this debt, so this debt that they're going to pay on is mostly Sing dollar denominated. Their debt, or rather their loan book, will basically be largely their loans will largely be in Japanese yen. So going forward, their interest cost will be significantly lower as the yen debt is much cheaper. Yeah, so basically what's next for First REIT is that they will continue to manage about 10% of the current portfolio, which is in Singapore and Japan, that assets, while they continue to transition to developed markets. So their ongoing strategic review, yeah, they're searching for more basically assets in developed markets, which basically benefit from lower equity risk premium and lower market risk premium as well as lower debt costs and more stable currencies. Yeah, so for them, for First REIT, the short-term challenge will be definitely finding any asset that can match the high yields of Indonesian assets, especially Indonesian yields of about 8-9%. So it'll be quite challenging to find any assets in the developed market space that can match that. But in the longer term, at least when they divest and they expand into developed markets, their portfolio quality will likely improve and will basically reduce currency exposure to emerging market currencies like the Indonesian rupiah, which has depreciated by almost 10% in FY 2025. Yeah, so that's for First REIT. I'll hand over time now to Ashim. Thanks.
Thanks, Darren. Yeah, I'll go through Air Transport Monthly. Next slide, please. So overall share price performance for our air transport coverage, China Aviation Oil performed very well. You can see that share price increased about 14.1%. And then Singapore Airlines followed suit at about 12.9%. SIA Engineering and SETS increased single digits. So the reason why we think China Aviation Oil outperformed is likely due to their results, 2H26 results, where their net profit was up about 70% year on year, which was better than we expected. So apart from their share price performance, there's quite a huge focus on fuel costs for airlines. And what we have observed so far, there are three strategies that airline companies are mainly using to deal with this share price increase. So the first one is hedging. So in Asia, SIA differentiates itself by hedging on both crude oil as well as jet fuel, whereas majority of the air carriers only hedge on crude oil. So from what we observed based on their November 2025 hedging, SIA hedged about 38% on jet fuel, about 9% on crude oil. So this relatively insulates them from the increase in fuel costs. The second way that airlines are dealing with the fuel cost increase is through fuel surcharge. So this is kind of a pass-over cost or pass-through cost to consumers, where airlines in APAC, including Singapore Airlines, are passing over about 15 to 30% on top of the ticket price. And lastly, some airlines in APAC, such as Vietnam Air as well as Philippine Air, both of them are grounding airplanes. If not, for the routes that there isn't enough demand for them to break even, they are cutting off those routes entirely for the time being. Recommendations wise, for Singapore Airlines, we have a neutral at $7. Fuel accounted for about 30% of FY25 revenue, so it's a very significant portion of revenue for SIA. But given their dual hedge structure, they are better protected compared to other airlines such as Cathay Pacific. Next, for sets, we have a buy at $4.44. So Europe, Middle East, Africa combined accounted for 20% of revenue. Their exposure to Middle East is not significant compared to North America and Singapore, which both are much larger. Because of this conflict, about 3% of their gateway services revenue is affected. But this is offset by the storage fees that SETS is able to collect because of the delay in shipping all these goods. For China Aviation Oil, we have a buy at $2.53. China Aviation Oil, historically, they procured jet fuel from Northeast Asia, so Japan, South Korea, China, Taiwan. And currently, because of this conflict, they are diversifying their procurement strategy by procuring from other places. The thing with China Aviation Oil is that it's huge, and as a result, they're able to procure large volumes, and they are also able to get better discounts on the jet fuel that they procure. And for China itself, the status right now is that Chinese carriers are able to fly over Russian airspace. So this is not something other Western aircraft carriers have. That's because they imposed a ban over their airspace, and Russia, in return, also did the same thing. But because China did not impose such a ban, they are now able to use Russian airspace to fly to Europe, and that increases their frequency of Europe-bound flights, which is a win for China Aviation Oil because they are able to procure jet fuel as well as sustainable aviation fuel for these international outbound flights. Lastly, for SIA Engineering, we have accumulated at $4.14, and we think our earnings are relatively insulated given the non-discretionary nature of aircraft maintenance. Next slide, please. So the chart on the left, it shows your 10-day moving average crack spread. So crack spread is your difference between your jet fuel and your crude oil. So crude oil definitely will be cheaper. Jet fuel, it's going to be more expensive because you're adding in the refinery cost. And in 2025, the average cost was $10.06. And right now, it has increased over $50. And that's about more than a 5 times increase. And this is very significant for airlines in Asia Pacific. And that's because even though airlines hedge on crude oil, they're still exposed to this crack spread, which they have to add um, on top of their hedge on the crude oil. So it's still a variable cost that airlines have to take into account, and it increases the cost base for airlines. So SIA is relatively insulated from this because they directly hedge on jet fuel, so they don't have to worry about this variable crack spread cost. So the chart on the right, it shows the Changi Airport passenger movement. You can see that it averaged about 6.5 to 7 million per month, and the movement is normalizing to low single digit growth. And we do think that there might be some increase in passenger volumes because of the Middle East conflict, where the airspace in Middle East is closed, and as a result, Europe-bound traffic might go through Singapore, Hong Kong, or Malaysia. But overall, it might not be very significant. Next slide. So the chart on the left, so we benchmark SIA with Cathay Pacific. You can see that RPK, revenue passenger kilometer, is the demand for air travel, and Cathay Pacific, their year-on-year growth is double digits, whereas for SIA, you can see that it's kind of trending single digit, and it's largely because of Hong Kong's post-COVID delayed opening up their borders, and as a result, um, the base which we compare to is much lower. So you can see that their growth is still averaging double digits. But overall, the yellow bar, which is Cathay's revenue passenger kilometer, has caught up with SIA Engineering's RPK. And lastly, on the right, you see China international air traffic, which is very significant for China Aviation Oil. Overall growth is still double digits, more or less, and yeah, we do think with the China Airlines exclusive access to Russian airspace, the international air traffic will continue to trend double digits going forward. Next slide. So lastly, this is the valuation snapshot. So from what we observed, SATS and China Aviation Oil is more unique in the sense that majority of airport services provider are private. So your Dinata, for instance, majority are private and publicly listed, that is global in nature. We only have SATS. There's another airport services provider in Turkey, but it's mainly focused in the EMEA region. And for China Aviation Oil, it's also unique in the sense that it has a monopoly over China jet fuel distribution, and it has a ownership stake in Shanghai Pudong International Airport, and no other jet fuel distribution or trading company has such a strong monopoly over fuel distribution. So with that, yeah, I'll pass it on to next.
Thanks, Harsha. I'll move on to the technicals. Next slide, please. Yeah, so first up, taking a look at the S&P 500, last week it rebounded 3.3%, and currently on the daily chart, we can see that price is did a recovery above the 5 and 10-day SMAs, which are the blue and red moving averages. So I think for this week, we are likely to see some sort of sideways consolidation with the next key resistance at the 20 and 200 SMA levels, which are the yellow line as well as the purple line you see in the chart. So overall, for the near-term support, is likely to be at 6,453 to 6,528, and resistance likely to hold at 6,600 to 6,650 area. Yeah, next slide. So the S&P 500 returned a 4.6%, negative 4.6% return in the first quarter this year, and then this table actually shows what's the following returns in midterm election years following a negative first quarter in the past 20 midterm election years since 1946. So there's been about 11 years where there were negative first quarter returns in midterm election years, so slightly about more than half of the 20 years. And then on average, the Q1 returns was negative 3.8%. After which we see that in the second quarter there tends to be a follow through in terms of the market performance, where the average returns tends to be about a negative 6.4% with about 27% chance of it, only 27% chance of it being positive. And the weakest month tends to be in the month of June, which averages negative 3.5% return, and only in 1 year out of these 11 years return a positive month in June. And last but not least, when we look out into the full year returns, following a negative first quarter, we tend to see negative full year returns as well, or averaging negative 8.7%, about 27% probability of gains. So I think if you look at the historical precedent, I think we could be looking at some further weakness going into the second quarter as well as the full year, following this negative first quarter in the midterm election year. Next slide. So we have our ETF monthly for March. We titled it Oil is likely to continue the outperformance in April. In terms of the performance in March, most of the ETFs actually were in the red. The top loser was the ETF tracking gold GLDM, which was down 10.9%. In terms of the gainers, the ETF tracking Bitcoin BITO rebounded 2.9%, and the top gainer was oil, which surged for the third consecutive month, up 18.7%. In terms of the current trends, most of the asset classes currently are in the range bound consolidation. Those in the uptrend are oil as well as Singapore equities, and Bitcoin is currently still in the downtrend. For April, we expect most of these asset classes to remain either sideways or continue our weakness. So the ETF tracking S&P 500, gold as well as Hang Seng Index could extend their weakness, while the US Treasury bonds, Bitcoin and Singapore equities could remain range bound. And we expect the ETF tracking oil to extend its gains this month. Yeah, potentially to hit about, if you look at the XOP, could hit potentially 202 level, which could be about further 13% upside. Yeah, that's all from me. I'll have the time to Paul for the weekly. Thanks.
Yeah, thanks, Zane. Sorry. So for this week, I only have Singapore Weekly, a short one. Yeah, thanks. Next slide. So in terms of some of the macro data that was released last week, the key ones was actually in Singapore was manufacturing activity, which is still robust. So PMI is basically like a survey to the factory managers on whether your orders are picking up or not. So for electronics, especially in Singapore, it continues to be strong, 51.4. No, a year ago it was 50.9. So the momentum for electronics is still strong. And if you look at the Korea's March exports, it spiked 48%. So this is the highest you do the numbers, more than 30. It's the highest in probably like 40 years in terms of the growth in exports in Korea. But some of it comes from higher petrol prices, but a large part of it comes from the spike in semiconductors. So we still think the semiconductor demand is still very robust. If you look at the export numbers in Korea and also in Singapore, there was all over the news. Of course, there was the payroll numbers. It beat expectations, but this is a very volatile number. I think the only message we can get or trend is that healthcare seems to be the only job that is growing in the US. So if you look at the past 12 months, the payrolls that has grown in the US has been about 300,000 or 295, and 600,000 of it has come from healthcare. So there's a lot of jobs being shed in the private sector, but only healthcare is growing. Not to put any jokes into it, but only healthcare is the only segment that's growing in the US. Next slide. In terms of our tactical views, so there was an address to the nation we all saw Thursday morning last week. All it did was just raise expectations of a prolonged war in Iran. I think that's why all prices responded by rising 10%. In terms of the monthly performance, Singapore actually outperformed. So Singapore, in US dollar terms, was down about 4% compared to US 5, and Asia Pac ex Japan actually collapsed last month. It's down about almost 14%. So inside the index here, you're talking about Samsung, you're talking about TSMC. So what did well for Singapore? We'll have all the charts later, but did well for Singapore were the basically themes around the Iran war, which is higher energy prices and defense spending. So of course, Wilmar did well because palm oil went up. Indonesia said they're going to push the biodiesel to 50%. And then ST Engineering did well because of the defense spending. You can only assume that the defense spending will be accelerated. And of course, Sembcorp did well because higher energy prices can benefit them. They are supplying gas to even other gencos. Year to date, no, Singapore still outperforms. It beat US by almost 10 percentage points and Asia Pac by 4 percentage points. In our model portfolio, is in our quarterly that we just sent out this morning. We added Sembcorp Industries that we mentioned why. We removed Singtel. So the reason why we removed Singtel is because of Singtel's exposure to emerging market consumers. So if you recall, no, Singtel's associates come from Indonesia, Philippines, Thailand, and India. And you can only assume that with the jump in fuel prices, the jump in inflation is going to hurt the consumer spending and also affect telco spending. Because in emerging markets, no telco spending, which is mobile, prepaid, top-ups, there's a bit of discretionaries. So it's not like us, I think every month you just get charged. It's not like we deem it like a utility, but there's a bit of discretionary spending in terms of prepaids or the load up. So that's why we think this will probably impact Singtel's associates at the margin. So in terms of our second quarter strategy, we titled the report "What to Do in the Fog." So the strategy is not to predict because it's so difficult, but to preserve capital. So we're bearish, I guess, in the near term. Our view is that the whole equities market is morphed into a volatile leverage short position on all prices. So basically, if it's basically the equities is basically the inverse of oil price. I mean, when oil price go up, then equities come down. So it's like technically you're shorting the oil price in the very near term. And so far, if you look at US equities, it's only down about 4% compared to, I think Zain mentioned before, compared to the two previous wars like Kuwait and Ukraine, I think, where the equities market came down almost 17% to the trough. So we worry that it's still downside, and also it's not just inflation and possibility of higher interest rates, but also there's a risk of material shutdown in global production. So we've seen shortage because of we see a lot of factories, a lot of chemical plants shutting down or force majeure. So this could be impacting plastic packaging, drugs, auto parts, medical equipment. So the whole supply chains can be affected if this prolongs even more. But the areas that we see growth will be the global capex cycle. This will broaden global capex cycle. Data center spending continues to grow. I think it's expected about 40% jump or 60% jump this year. Semiconductor equipment also jumping about 30%. Then defense spending, of course, will get accelerated, especially in the Middle East. Renewable energy becomes even more important for national security reasons. And of course, you have this expected 200 billion spending to rebuild all the Gulf countries' damaged infrastructure. So we think capex cycle will be the areas of growth as we post this war. Some of the events looking our webinars for this week will be CNMC Gold Mine on 8 April. So we want to know more about gold production in Malaysia or even gold prices. You can dial in; it's open to everyone. We also have our Singapore SSP. The event is longer, so our portion is about, I think, 2:30 to 5:30. For the Singapore side. And then in the US, it's the following week. Next slide. I'll move on. These are some charts. If you look at the momentum, so there's momentum in manufacturing in Singapore. If you look on the right, so these are the exports. So you can see this in Korea. This is the 3-month moving average, but the Korea is a vertically lift off. So it's like really big spike. Taiwan already had the spike. It's come down a bit, but it's still very robust numbers. You're talking about 40% growth in exports in Taiwan and about 30% or high 30s in Korea. Taiwan haven't really released the March numbers, but you can see the semiconductors really pulling up everything. It may not be volume, but it could be just prices, especially the high-end semiconductors. Next slide. Move on to our usual monthly performance. This is just a checklist of the monthly performance. On the left is the monthly performance of Singapore market by sector. So what did well was commodities, like Wilmar and so forth, and the plantation companies and also the coal companies. What performed badly was REITs. You can see here -7, minus everything minus, and most sectors minus except banks and also industrial. Industrial here we're referring to some of the electronic companies. On the right, yeah, so sorry if there's an error here. The gainers should be losers and the losers should be gainers. If you look at the top, so the big losers, not gainers, sorry, obviously, Rex, Yanlot, a lot of the property names, Yang Chichang Financial, WeHer, UG, so all these were the losers. The gainers was Alltech, up 80%. They also announced a contract this morning of 350 million US, or almost 1.4 billion. So this will push their order book 5 times, from 300 million to 1.7 billion. So it's a huge order book that they're getting their first sustainable aviation fuel oil contract in Malaysia. Some of the other gainers here was like plantation companies like Bumi Tama, First Resources, and then the semicon names also did well, like AEM, Micromechanics. If you look at the bottom here, so these are the Straits Times Index gainers and losers. On the bottom is Wilmar. So like we mentioned, all the defense, agri names and SGX. The losers. So of the 30 names, only 5 gained. Congrats to those who got the 5. But the losers for everything else, especially property and yeah, you name it, and REITs especially all got knocked out. Yeah, for last month. Next slide. So this is the performance by asset class. If you look at the asset class, Singapore, although it's down in US dollar terms 4%, it actually kind of outperformed all the equities. I mean the broad equities. The other, so you outperformed REITs. REITs was in Asia Pac ex Japan because of the heavy technology exposure. Of course, all the US names. Year to date, the outperformance compared to the US is more significant. You can see year to date, Singapore is up 5, the US is down almost down 5, so it's almost a 10% difference. Commodities did well, of course, and gold is down. These are ETFs, and bonds is also down, yeah, always down. Bonds has been weak, yeah, down 2.4. For your reference. Next slide. So just last 2 slides. So this is just, well, this should be our last slide. This is basically the performance of the Asian markets in local currency terms. So what was sold off was South Korea. So even though South Korea is down 19, year to date is still up 920. So if not for the current sell down, would be up 40% because of semiconductors and so forth. Japan is also down and so forth. One of the performers is the Singapore banking sector. So you can call. I'm just claiming it's a safe haven. I mean, of course, if everything goes down, it will also go down. But at least for last month, it was a safe haven. Yeah, just for your reference. Next slide. And this is our model portfolio. We were down, I think, 5%. If you see on the left here in the red box, basically all the segments was hit. Even Franken, property, REITs, everything. What pulled us up was OCBC and also Geo Energy, which is up about 24%. We removed Singtel for the second quarter and we added Sembcorp Industries. Okay, thanks everyone. I think we can move on to, should be the last slide, I think. Yeah, I can move on to Q&A. Yeah, thank you, everybody.
Hey, thanks, Paul. Let me just take on some of the questions first. Try to find some of them. Okay, I think there's quite a few on the EVs. Let me do that one first. So yeah, I think just asking, now with the spike in petrol price due to the Iran war, the sale of EVs should also spike, in which case BYD is a buy, is one of the questions. There's also another one asking, will this actually help Tesla, right? Because whether or not the spike in petrol price will actually help Tesla with their sales. Yeah, because of higher adoption of EVs. So I don't think it will be meaningful. Because the thing holding back people from buying an EV isn't really. I mean, okay, that's definitely one of the options, right? The petrol price. It's cheaper when you use electricity to charge instead of using petrol to pump a normal standard ICE car. But I think for Tesla specifically, it will not be just because of that. That will not be the thing that will change their mind. There are so many options, so I don't think it will really help Tesla. The reason why their sales is declining is because, firstly, of course, the market, the market is actually doing the overall EV market in the US is growing, it's still growing, but Tesla is losing. Their deliveries are declining. Yeah, so you can see that there's already a difference. So if the EV market continues to grow, I don't think Tesla's deliveries it might grow, it might decline slower, but I don't think it will really help them much because their cars cannot compete with the competitors. Like you have Kia and Ford and all the other cars that are coming out with EVs that are better, newer, more innovative than Tesla. So Tesla is really only. There's also another question. Sorry, that question jump on Tesla whether or not SpaceX. Yeah, and how does the SpaceX listing affect Tesla stock? Will investors sell out if they only want to buy SpaceX? Yeah, I mean, if they only want SpaceX, then they will definitely go for SpaceX because Tesla is very different from SpaceX, right? Tesla is now they are selling the whole idea on full self-driving, autonomous driving and robotics, whereas SpaceX is more about exploring space. Yeah, so we don't cover SpaceX, so there's a whole different Pandora's box you want to open if you talk about SpaceX. Yeah, but I don't think if they want to buy SpaceX, they'll probably shift. Yeah, but I don't think this EV, this petrol price will really help Tesla. Whether or not BYD, there could be a possibility, but again, you must see the infrastructure. Like even if you look at Singapore as an example, a lot of people don't upgrade, don't change. Sorry, not upgrade. Don't change to a. Excuse me, sorry. Don't change to an EV because there's no infrastructure. If you live in a high-rise apartment, or a flat or HDB, you have to fight with many people for a charging unit. So in compact city-like environments, right, it will be a harder push to go and change. There's no really pull to change to an EV. So we might not see the growth there. Like people who want to buy an EV would have already gotten one. Yeah, but I would think that there might be an uptick in EV sales, in the next, at least in the next few months, if the crisis continues and oil prices also increase. But of course, you also have to take note that the EV charging will also increase. There's been news and reports coming out that electricity prices have increased. I mean, in Singapore as well, you see that your tariffs are spiking up, right? And this will also flow down straight to your EV charging. So it's not that there will also be an increase in your charging. Yeah. So that might actually push back some people from buying an EV. Sorry, where's the question? Okay. Yeah, there's also some questions on the banks. I think it's asking, why did OCBC outperform, and what is the play now in Singapore banks in view of the current uncertainties, and if DBS is still my top pick. Yeah, so for that, I did go through a bit earlier, when I was talking about the banking monthly. But let me reiterate again. Firstly, why did OCBC outperform in the recent few weeks? Is mainly because, firstly, I think there's a bit of a rotation into banks, right, out of the interest rate sensitive sectors. Like I think Paul mentioned, property developers and REITs, they're moving out and then they're going into the banks. So when you look at the three banks in Singapore, DBS might be a bit pricier because of its valuation. Currently, DBS's PB is at 2x, when you compare to OCBC is only 1.2. And also then you look at their bottom line, their earnings. OCBC was also the only bank to really post a year-on-year PATMI growth for fourth quarter 25. Right. So with all that being said, you want to get the best value and also the fastest growing. Then you look at OCBC and you say, yeah. And also another reason would be they're very high capitals. Excess capital, there is also quite a bit of upside potential, in terms of whether or not they're going to give back more, because they don't have any plans for acquisitions, any big plans for any acquisitions. So the only way that they can reduce their CET1, right, from the current around 15% to the optimal range of 14% is either by doing acquisition, which they don't really have plans for, and nothing in the near term, and also the only other second way is either share buybacks or giving back in terms of dividends. So we believe that there is some upside potential for higher dividends. And the new CEO did say I think it's the first time in years that we have heard that he said that they would much prefer to give back special dividend instead of a share buyback. So we're already looking at one leg up there already, because if they don't clear that 700 plus million that they have left in share buybacks in this year, then we could see that given back as a special dividend at the end of the year. So we're assuming that's around, I think, 10 cents per share, dividend per share, extra if they don't fully clear it. Sorry, I think that's one of the questions on DBS. But our topic will still be DBS, mainly because of they have the largest deposit base, right? And they also they stand to gain the most from the higher for longer interest rates. And lastly, they also have the most you can forecast the dividends the best because they are still giving back more, even though earnings have declined slightly, and their dividend payout ratio is also the highest. Sorry, let me see where's that question. I mean, there's someone also asked. There's also share buyback, but there's share buyback that boosted OCBC's prices. But then again, there's share buyback by all the companies as well. No, GE is still a big contribution to OCBC earnings, about 10 to 20% of their bottom line. Sorry, we don't cover SpaceX, so a bit hard for me to compare it, for the IPO, whether it's, we have a sell call on Tesla, so that should tell you a lot. Hold on, let me see. I think maybe I hand it over to the rest of my colleagues first before I take on the rest of the questions. Thanks.
Thanks, Glenn. I'll take on some questions. So which Singapore and US stocks are impacted by higher aluminum prices? I'll just answer on the semiconductor part, and then I'll just leave the question here in case my colleagues have things to add. So for semicon, aluminum makes up a very small component of the US semicon companies, for example, NVIDIA, AMD, and Micron. It takes up only 1% or 2% of their cost of goods sold. Most of the cost usually goes to memory chips, as well as the manufacturing from TSMC. So they're not really directly impacted by the higher aluminum prices. For Singapore stocks, my view for Franken is that they are also not that impacted by higher aluminum prices because second half of last year itself, the prices have already spiked, but their results are still holding. Their gross profit margin has expanded, even though there's a spike in aluminum prices. So I don't think it makes up a huge proportion of their cost of goods sold as well. What's your take on the NVIDIA Marvell partnership? So just some context. NVIDIA invested $2 billion in Marvell. This is so that my view is that this is so that they can gain more exposure into the custom AI chip space, where NVIDIA is indirectly competing with Broadcom, because Broadcom is designing the custom AI chips for the hyperscalers. So with this partnership itself, I do think that NVIDIA is trying to break into this space as well, have more exposure so that their customers, which are the hyperscalers, will be able to use NVIDIA software ecosystem for their custom AI chips. And I think it's a big benefit for Marvell in this partnership, because now Marvell will have access to NVIDIA's CUDA software ecosystem in order to design their custom AI chips. So there's a question. Please update WeHer Centurion for the next 12 months. So our target price still stands. Centurion, our target price, our latest one was 1.81. We do think that their results will be supported by the property management fees of the REIT itself. and after and they also mentioned that they will pay off some dividend in specie during the upcoming AGM itself, even though it's still subject to shareholders' approval. So after paying out this dividend in specie, they will hold about 37% stake in REIT itself. Yeah, so this will also support their revenue and earnings, even though we do expect the profits to drop this year because of the spinning off of about 50+% of the REIT itself. Yeah, but in terms of top line itself, it will still be a consolidated numbers for revenue. In terms of WeHer, yeah, so I think there's also one more question at the bottom. Why WeHer share any bad news and any reason analysts still say can survive despite market down? Yeah, I think you're asking why is the share price down for WeHer so much? Yeah, so I'll try to address this for both questions. So for WeHer, my view on why the share price has been down is because there is this backdrop of their Tuas Hill dormitory, Tuas Hill dormitory, which is a 16,000 bed worker dormitory, lease expiring in November this year. Yeah, so that is the backdrop of the risk that some shareholders may take into account. So November this year, we do expect the results of whether the lease can be extended to come out about 3 months before the lease expiry, which is about August this year. And management has updated their in talks with authorities already. So we do think that this is a good sign because as the talks progress, then the authorities will be able to make informed decision. And we do think that with the major construction projects coming up, the authorities will not just cut off this 16,000 worker dormitory bed supply from the market itself. And this 16,000 bed Tuas Hill dormitory is also compliant to the new dormitory standard in 2030 itself. So I do think that there is a high chance that the authorities will extend. Yeah, hopefully that gives a better some insights into WeHer. Yeah, so their recurring results will still be supported by the construction and worker dormitory standards. The upcoming Pioneer Lodge, which has 11,000 beds, which just obtained TOP last year. So this year it will slowly start to ramp. And for WeHer itself, there's also other assets. For example, their property development in Australia, their Upper Thomson GLS, their investment property hotel, as well as the 3 student funds. So we estimate in total about $450 million worth of assets. So we do think that WeHer has all these potential assets to be monetized. And currently WeHer is trading at below book value. Their book value is $0.71. And currently they are trading about 64 cents. Yeah. So we are still positive on WeHer. Yeah. I think that also answers one more question. Why is WeHer share price much weaker than Centurion? Because of the backdrop of the lease expiring. Sorry, the questions are skipping. Any view or research on M&E player King One? Yeah, we don't cover King One. But just to give some context, you're right. They are an M&E player. I think a lot of their projects got to do with HDB BTOs. So with the ramp up of HDB BTO supply over the past year as well as this year going forward, we do think that they will benefit from this trend because M&E projects generally follow the construction cycle, and there's also a big portion of revenue recognized at the end of the project itself. So that should benefit King One. Yeah. Any comment on AEM recent run up? And between AEM and Franken or UMS, which one is the top choice and least choice? Yeah, so I think the recent AEM run up is because during their earnings call itself, they mentioned that they are in talks with hyperscalers as their customer. So they are potentially announcing a win this year. So I think that has led to the run up in stock price. Between AEM, Franken, or UMS, which one is my top choice? I think based on valuations wise, my top choice will still be Franken. Currently, Franken is trading about 20 times forward PE compared to AEM, which is 38 to 40 times forward PE, and UMS is about 25 times forward PE. Yeah, so I think based on valuations, my top choice is Franken. And Franken, we are also looking forward to second half of this year where ASML will start to ramp their high-end EUV machine. And we do think that EUV is high in demand now because especially with memory players shortage of clean room space because EUV machine is able to to carry out the lithography stages in one single machine as compared to previously in the DUV stages they need 3 to 4 different sets of machine to carry out the lithography stage. Yeah, so currently there's a lot of orders for ASML's EUV machine. Yeah, which we do think will benefit Franken. Let me scroll. May I have your view of Viho should continue to hold? I think I answered that question. Yeah, so we are still positive. Our target price still remains at 1.08. Yeah. How are US semiconductor exports performing? Are they a key contributor to overall exports? Yeah, sorry, I don't have the export numbers now, but I think I would expect the exports to increase, especially with Intel as a foundry in US as well as Micron as well. So my guess is that that the semiconductor exports should be increasing, but let me dig out the numbers and update you again. Yeah. Yeah, I think I can hand over to my other colleagues for now. Yeah, thanks.
Serena. Okay, never mind. We just okay. Thanks. Let me just move on to which Singapore US stocks are impacted by higher aluminium prices. I'm not sure about US stocks, but for Singapore stocks, what come to mind would be the OSV makers. So those who make the aluminium boats, especially the CTVs by Marco Polo and also Pacific Radiance. There could be some impact, but I think all this can be passed on. I think because this is not just impacting them, it's impacting all the manufacturers. The US, I'm not particularly sure. There could be some impact on the construction companies, but very immaterial. I mean, these are like some of those window frames and so forth, but I don't think it will be a meaningful impact to them. Yeah, because the whole building and window frames probably not the largest part of the cost. Um, Hi Paul, why are glove stocks active? There are two things. There is basically the US dollar has strengthened against the ringgit, so this will benefit them. And has started to strengthen. And also the second reason is because Top Glove mentioned they are raising prices to pass on higher costs. So, but for me, I'm just still a bit wary of glove makers because the Chinese competition is still so intense. I think in a very broad sense. Hi, Paul. Regards to Sonic Aerospace, what sort of inorganic growth do you think the company will pursue with the do you think the company will pursue with the cash? Okay, so for Sonic, we did come out with a non-rated report. The stock is trading, I think, 20% below cash. So they are buying back shares as much as 53 cents. It will be many tuck-in acquisitions, or maybe similar logistic companies in the ASEAN region, which is also asset-like. So at least they can build up the scale their logistics business. So this is what we think they will do. I don't think they will issue shares because it's below, right? It's below book value and even below cash. But they could start to use that, use the cash pile that they have. It's about 40 million US. Yeah. Any updates on Teletrust proposal for data center projects? Yeah, so Teletrust made a very unusual announcement. They announced that they are bidding for a very material project. So to announce that, number one, it has to be really big to even announce that you're bidding for something, and number two, they must have quite good chance of winning it. Otherwise, they won't say, they won't even mention it. Otherwise, it can be misleading. I mean, that's my interpretation. So the big data center project is in Malaysia. They didn't say much more. And when I read the news, they said that it's also going to be regional. So I think this project or partnership that they mentioned is not just in Malaysia, but it could be even the whole region in ASEAN, my guess. So it's going to be a very meaningful contract. And this is a ST Telemedia company. Right? For them to mention, to avoid misleading, they must have quite a good chance of winning it. Others we won't even, I don't think the lawyers won't allow them to mention such thing. Yeah, because it can be misleading. I mean, imagine if you don't win it, right? Then the amount of fallback you're going to get. So I think the chance should be quite good. This question is for Hashim, SI Sets and SI Engineering. This one, the pawnbrokers, I think I'll leave it to Glenn. Is Sheng Siong a safe haven during this war? You can say so, but if equities fall, there is no safe haven, no absolute safe haven. There's only relative safe haven. Maybe you lose less. I mean, that's probably the safe haven. If the whole equity market, that means if ground troops, if Trump were to attack the facilities, civilian infrastructure, then all bets are off. I think then this war could prolong. Yeah, then all the supply shocks, shortages in a lot of products will flow through more permanently. Yeah. So if that happens, there is no safe haven. There is relative safe haven. You lose less. I mean, he who lose less is the winner. I guess it's called safe, relative safe haven. But I think Sheng Siong is a safe haven in the sense that they are consumer staples. So supermarket is something that you need to consume, regardless war or no war. So it's not discretionary. So you are right now in the sense that it is a safe haven. How are logistics stocks impacted in this war? They could benefit if, for instance, if you look at Sonic, which is like a freight forwarder logistic companies, if the freight charges run up, that means if supply suddenly constraints, then there's opportunity for freight rates to rise, and they normally earn quite a flat margin on the rates. So when rates rise, they will benefit. But it will. But right now, at the moment now, there's a lot of fuel surcharges being imposed for logistic companies. But if there is the war prolonged, overall, if you assume global economies come down, then it won't be a positive. Yeah. Because logistic companies still depend on global flows. So just to mention, like what you mentioned last week, if this war prolongs, it will be even worse than the pandemic because there is shortages of products. At least pandemic, global trade still float. All of us still bought a lot of things on Lazada and then you still get it. But imagine if there's no packaging material. I'm talking the extreme, no packaging materials. Because polyethylene prices spiked up also. Apart from things being expensive, there's really going to be shortages. Fertilizer impacting ceasing. I'll let Serena answer that. Okay. Hi. I'll answer this last one, then I'll hand it over to the rest. Hi Paul. How about Bumi First Resources? Are they safe haven when the war erupts? You could say they are probably a better safe haven in a sense because they are more linked to energy prices. So, because of there's also a biodiesel mandate being ethanol. I think it's biodiesel. There's a biofuel mandate being raised in the US. So that's why soybean prices also spiked up, and also that's pulling up palm oil prices. Not to mention the biodiesel mandate jumping to 50. It will push up demand by almost 4 million metric tons, which I think is 5% of global supply. Don't hold me to the number, but it's significant at the 4 million. I just slipped my mind. To me, the palm oil companies are probably a better safe haven. The issue for them is fertilizer, but I think most of them have enough inventory, and any impact on fertilizer from lower production is probably like a year away. It's not like you don't apply anything now, then suddenly there's no fruits. So this is like a 1 year thing. Yeah. Uh, okay, I'll leave it to the rest to answer before I jump back in. Yeah, thanks.
Thanks, Paul. Yeah. Let me just do the one on the pawn shop one. Yeah, sorry, I missed it earlier. So yeah, the question is asking if gold prices remain weak for a prolonged period, say 1 year, how does it affect pawn shops like ValueMax and peers? Yeah, good question. So the first one, they would have some compression of their net interest income because if they put the loan quantum is based, and of course the interest charge is based on the value of the gold. So if gold drops, then the gold price goes down, then of course the value of their loan will suddenly go down as well, and then the net interest income will depreciate, will go down as well. So that would be the main. That is one of them. The second one would be so yeah, just to have some the business model of the let me just try to explain this quickly. So yeah, the business model of the pawn shop is basically that the borrower will pledge the gold, let's say a gold chain, and then they will take based on that price of the gold. So what happens? The risk is that if the price of gold does fall below the value of the loan principal and the accrued interest, the borrower will basically just take the cash and walk away, because then now whatever he has or they have is more than what the price of the item that they pawned at, right? So, but one way that the pawn shops are able to buffer this is that if the price does go down by around 20-30%, right, they will lose, but the blended average will be able to take the hit because the LTV that they take the gold at, right, the item at, is usually at 75-80%. So they do have that buffer of around 20-25% of buffer, right? So it's not so bad in the sense that even if the customer walks away, then they can still, they have that sort of a buffer. Yeah, and then the pawn tickets are also around 6 months, so that's where they're looking at the average, the blended average of. So they take it over quite a long period of all the items that they have. Yeah. So I answered that question, and then let me take the next one, which is, do you see a slowdown in ASEAN loans growth? Some ASEAN countries like Thailand and Philippines are facing fuel shortage. Yeah, I don't think it's too early to say now whether or not we will be seeing a slowdown. But I think I mentioned it earlier in my banking monthly when I said that's one of the main factors that we are looking at the segments, because this is basically the emerging market segment. So for the three banks, loans growth has been quite slow for the ASEAN segment, right? They only had low to mid-single digits, and then this would what we can tell from this is that there has been not really a lot of aggressive build-up, right, where we could amplify the risk of a lot more defaults. And the banks also have very ample buffers, right, above 100, close to 100, or even above 100% for DBS and OCBC. Yeah, and the segment that the loans that ASEAN makes up for the banks are not as big as as Singapore or Greater China. Yeah, okay, I think that's all for me. I'll hand it over to the rest of my colleagues. Thanks.
All right. Yeah, thanks. Then let me answer some questions. Maple Tree Industrial, please comment on its recent price downtrend and what's your TP. Yeah, so we don't cover Maple Tree Industrial, so you don't have a TP. But generally for all the REITs, the recent weakness is generally because of the expectations of higher interest rates and probably stagflation worries. So that means tenants will likely possibly start to struggle, and that would definitely impact a potential for positive rent reversions going forward. So that is a slower rental growth, and higher interest rates, the possibility of higher interest rates. So that's why a lot of REITs also, the share price did perform so well over the past month. But for Maple Tree Industrial, over the past few quarters or so, the share price also underperformed the general REIT market, generally because of the fact that they have it's known that their portfolio of data centers is a bit dated. So and about 5% of their leases will have already indicated non-renewal over the next this year and next year. So that's for the North American data center portfolio. So that's also for the reason why the Maple Tree Industrial, the share price has underperformed general REIT market also. Yeah, so but in more recent times, it's more of a macro thing that basically all the REITs are down. Yeah, but if you want to know the trend in the TP, I'll leave it to Zane for the technicals. Yeah, the next question is capital ascenders rights issue. Retail investors offers unit price of 235, where AI investors, basically the retail, the preferential offering trench at 235 versus the private placement trench at 240. Any comments on this and our view whether it's still before the best so? Yeah, so if you are an existing unit shareholder, if you are an existing unit holder, definitely I would recommend you subscribe, because otherwise you'll be diluted. Now the share price is about 250. Yeah, if you subscribe at 235, if you don't subscribe at 235, you'll definitely be diluted. And this funds will be used to fund and accretive acquisitions of a few properties. And on the question of whether going forward is still one of the best REIT to own, yeah, for that, basically Ascender REIT's one of the largest, not the largest, industrial logistics player, business space also. So it's generally by scale, it's one of the largest, and also it provides like 5 to 6% yield. So if you want exposure in this segment, yeah, you can't go wrong by just holding the largest player in the market. Yeah, so that's my general view. Yeah, but if you're an existing unit holder, yeah, I recommend you subscribe to the rights. The target price for United Hampshire was 69 cents. It tanked to 50 cents now. The TP still holds. Yeah, so for United Hampshire, our TP still holds, and our recommendation of a buy call still holds as well. Yeah, but that's mainly because of the fact that their portfolio is exceptionally resilient, especially in the current situation where there's war and such. Because of their high occupancy at 97%, also their very low leases that expire over the next few years. Their WALE is also very high of 7.7 years, and they have a very high tenant retention rate as well. So basically, the portfolio, the rents are very stable. So they are one of the basically very resilient REITs, and they are paying a yield of, after the share price decline of almost 9%. So yeah, our target price still holds. Yeah, the portfolio basically is underpinned by essential services and strong grocery and necessity properties like the strip centers. So those are very resilient. Yeah, any particular reason for Stonewax REIT share price? Yeah, I think that is not so much micro, anything that got to do with Stonewax itself. It's more of the macro theme. Yeah, so that's for Stonewax REIT share price. Is Singapore REIT still a good sector to accumulate in current ME Middle East war uncertainties with Fed unlikely to cut rate anytime soon? Yeah, so for Singapore REITs, we think in the near term it might be challenging, like we mentioned, because of stagflation concerns. But generally, we still see some capital flows into the Singapore REITs because of its safe haven status, like stability, like its retail reversions, also a positive rent reversion and escalations and stable yield. So generally, we still think it's relatively resilient, but we have to be careful in which REITs we pick and choose. Yeah, and not all REITs will perform well. Yeah, but generally, for those Singapore REITs, especially those with Singapore SGD denominated loans, those have really performed well, and we expect those REITs to perform even better as the SORA rates, the base rates, keeps declining. Now it's at like 1.1. So a lot of REITs, they still have room to benefit from low interest rates as they reprice their SGD loans at the lower base rates. Yeah, so So yeah, the Singapore REITs will still benefit, especially with those with SGD denominated loans. Yeah, okay, I'll hand over to my colleagues for now. Thanks.
Yeah, hi. I'll answer the questions for the fertilizer. So the question is, does fertilizer prices impact Zixing? I think yes, there will be some of the impact because of the higher price, but Zixing actually very focused on sustainable farming, as in before they harvest a sweet potato, they spend quite a lot of time um to actually take care of the soil health. So I think so that the produce will be more on a high quality. And also the company actually operate waste management business as well. They turn like sweet potato waste into animal feed, and recently they do have a renew order to 360 ton, which is like double quantity compared to before. So I think yes, I mean, when it comes to planting the produce, it will be, but because of the sustainable, and also they also involved in the waste management business, it actually helps to put some buffer, I guess, and also like diversify, and also diversify the revenue stream as well. And I also see there is another questions about Meta. Second, you pull out the exact questions. Yeah. Serena, Alphabet and Meta, any comment on the current price movement and your target price of this counter still valid for the next 12 months? Yeah, at the moment our target price haven't really changed. I think the reason price movement is slightly tied to the overall market volatility, and of course, the court case. The recently they are actually liable for like two court cases and actually have to pay for the fines too. But then like I think like I mentioned it last time the webinar, the company is still trying to appeal the case, and I think the long term impact will be if there is any changes to the platform. So at the moment, I think that the volatility is short term based because of the overall market. I think, like I said before, the fundamentals still very intact, because I do believe that both companies are they will still very stick to the CapEx spending plan on AI. But I think short-term one will be slightly cautious on the higher energy prices, because it definitely will impact their AI capacity expansion. But long-term prospect, I think both company main segment at the moment is still showing a very strong demand, and their cash flow is still also shows that they remain very strong to afford it. So yeah. That's why at the moment the target price haven't really changed. It's still, so I think it's still valid for the next 12 months. Yeah. Um, I think that's all. I'll pass the time to my colleague for other questions. Thanks.
Hashim?
Yep. I'll take a few questions. I think first question is your view if this is a good time to accumulate sets and SIE. So for sets and SIE, when you're looking at their share price from the start of the year to date, both of them have fallen. Sets is down about 6%. SIE Engineering is also down about 10%. And share price wise, both have fallen from their highs already. Fundamentally, both are strong businesses. And their PE ratios have also came down. So for sets, when they acquired WFS, their PE ratio was over 100. Currently, it's trading about 20x. For SIA Engineering, their PE ratio post-COVID was about 80. Currently, it's about 26x. So for sets, we definitely think it's a buy if you're a long-term investor. It has came down from its high valuations in the past, and now it's a good time to enter if you are investing for the long term. For SIA Engineering, it's trading close to historical average of about 24x. But if you are investing for the long term, your entry shouldn't matter because SIA Engineering has a strong uh, unique selling point, which is their JV with MRO companies. And we think this will continue to be a strong point for SIA Engineering going forward. What's the net gain or loss for SIA considering the cancelled flights between Singapore Dubai, but added more flights between Singapore Europe? Directionally, we think it may be a net gain in the near term. So SIA was operating one route, Singapore Dubai, and that's just one route. And when you're comparing that to Singapore Europe, SIA benefits because firstly they are able to capture the demand from say South Asia to Europe that previously had a stopover in Middle East, but now is going through Singapore. So the stopover demand is something that they're capturing. But apart from that, they're also increasing the frequency of direct flights to places in Europe and London. So Singapore to Gatwick, they have increased from 3 to 10 times. And overall, we think in the near term, it would be a net gain for SIA because um, it's servicing a larger group of passengers, and this demand would also likely drive their yield. So directionally, we do think it would be a net gain, but we can't give you the exact breakdown. Any potential for China Aviation Oil to reward shareholders from their better than expected financial results, like special one-off dividend? So our view is that they may more likely do acquisition rather than provide a special dividend at the moment. So companies, they want to put their capital at where it works best and where they can get a higher return. And from what we understand, China Aviation Oil is more inclined in using their cash to pursue acquisition. So previously they told us that they might do investment in SAF related infrastructure or storage tanks, and we think that would be more likely, but we are not, yeah, we are more inclined towards there being an acquisition rather than a special dividend. What are the drivers for recent fall in gold price, sector rotation going on? Yeah, you're right in that there is a rotation in capital. So because of the likelihood of a rate cut being on hold, um, new US treasuries are more attractive to investors, and so capital is flowing from gold to treasuries. And also because you might have seen that Turkey, which is one of the largest one of the largest holders of gold, sold about close to 8 to 9% of their gold holdings, which is very significant, and that also drove a recent fall in gold prices. And lastly, because of the US dollar, it's been stronger, and this affects foreign countries trying to buy gold in their home currency. So it's going to be more expensive in US dollar term, in their home currency term. So I think there's one question in the chat. What do you think of gold price going forward? Is it a good time to invest in gold fund now? So our view is that currently gold would continue to face weakness in the near term. But if you are a long-term holder of gold, if you look at gold charts going say 10 or 20 years back, gold has always been increasing. So Yeah, now might be a good time to invest in a gold fund if you're bullish on gold and if you're a long-term investor. If not, you can consider miners like CNMC, which benefit from operating leverage. And it is also providing dividends for investors. I think that's all the question I have. I'll pass on to others.
Yeah, thanks, Hashim. Yeah, we just do a very quick as much time we hand it over to Zain. Okay. The next question is private home prices rose at a slow pace in first quarter 26. What's the outlook for second quarter 26 and impact? Actually, property prices doesn't really impact Pronex as much as volumes are. So volumes is key. Of course, prices is also important. But if you have too strong a price, so you start to worry about the share price in terms of the authorities putting in cooling measures. So the impact on Propnex is just that this year will be the year of consolidation. I think last year the launches again. Sorry, I can't have the exact number, but last year launches was 11,000. This year launches probably 9,000. So this will by default just cause the earnings or revenue to come off this for this year. So that's why this year will be the year of consolidation for Propnex. So it's not so much the pricing. Pricing should be stable, maybe 4-5%. And you do not want it to be too strong too. And then after you worry the stock gets sold off because the cooling measure risk will come in again. So volumes are more important. Because the bigger thing is just that they are just confined to Singapore. Although so one thing is to raise the market share. So that's one of the areas. Although they already have like 60% market share, so that's one area of growth for them. Does ST Engineering benefit from US defense budget? To a limited extent, but the bigger opportunity for ST Engineering is the Middle East. So like we highlighted before the war, they were already supplying ammunition, and they just got a big maintenance contract in the Middle East. And why they have an advantage in Middle East is because they can help the Middle East countries localize. So a lot of Middle East country not just want to buy the product, they want to localize. They want to have their own ST engineering. Because one of the big achievements we did was we built out our own defense contractor. So and then for security reasons, you want to localize the production, everything. Because you can't be like relying on when there's a war and how to ask Singapore, Singapore can send in some ammunition. When you cannot even fly in, you cannot ship anything in. So localization is one of the advantages because ST Engineering is willing and able to do it. All tech news this morning, good, yeah, because it will push the order book by 5 times, and also, of course, earnings will also jump tremendously. Of course, this is still a heads of agreement. You still need to sign the definitive agreement in 6 months' time. Just one last comment before I hand over to Zain. I think there was this thing on the SpaceX. So SpaceX is a very crucial thing because SpaceX, if it happens, it should be almost 2 trillion, and then it's going to push up all the trading liquidity. All the brokers will also benefit. I'm not sure about the local brokers, but hopefully Phillip also benefit. But the whole broking industry will benefit because if you got such a huge IPO, including like Robinhood and so forth. And the rumor is that Starlink might merge with Tesla. I think that was one of the things. Okay, I hand it over to Zain to clear the rest. Yeah.
Yeah, thanks, Paul. I'll take on the TA questions. Yeah, so first question is on some US counter. So first one from Broadcom. I think the stock we tested this key support at 295 last Monday, I think. And then we're seeing some rebound. I think short term wise, we are likely to see some sideways movement. I think key resistance around the 320 to 326 this area, and support is likely to be still, I think will still hold around 307 to about 311. On the weekly chart, I think it's clearer. You can see that in terms of the resistance, the key resistance has been mainly along the 5 SMA weekly, which is the red line. It's currently standing around 321. So I think for now, still very much sideways for Broadcom right now. In terms of NVIDIA, I think in terms of Nvidia, I think some slight weakness as price is still remaining under this upward support line, this blue line over here. And then I think in terms of the current resistance, in the near term should be around 181, this level over here. So that's for Nvidia in terms of the short-term resistance 181, which is also the 10 and 20 SMEs on the weekly as well. So this has been, I think, as a bit of a resistance since about start of March this year. Next counter is on 5 below. So for 5 below, I think overall it's still a very strong uptrend overall, whether you're looking at it in the short term or the longer term. Price I think is retesting around the previous all-time highs around 237. Yeah, and also another positive thing is that this key resistance in the past around 214 price has remained above this resistance, holding as support for quite a long time. So short term wise, I think it's trading in this uptrend channel. For now, I think still looks very positive. Of the key support, I think for now is still around like 228. So probably forming a bullish flag above this previous resistance, and I think there's still a good chance of it forming a higher high afterwards. Next one is HWM Howmet aerospace. So for this, it's also an uptrend. For now, I think some pullback taking place, but I think likely support is still should be holding around this 226 retest of this prior resistance for now. So I feel it's probably a bit of a short-term sideways move consolidation that's going on since mid of March. Resistance probably from 239 to 245, and then supports from like 226 to about 230 area. Next one, back to some Singapore counters. First one on sets. Yeah, for sets, I think right now we're probably seeing some share price consolidation. I think key resistance is around the 20 SMA for now. That's holding as resistance since March. So that's currently around 361. That's likely to be resistance. In terms of support, I think is holding around the 352 level. So probably some sideways consolidation for the time being right now. And for SI Engineering, I think it's also a bit of a sideways consolidation movement. Okay, price is forming a bit of a higher lows in the short term since the pullback ended on 9 March. So some slight higher low support probably around 323, and resistance I think for now generally around the upper Bollinger Band around 331, right? So very low volatility right now. So probably some sideways movement as well. Next one for Centurion, also quite low volatility for now. So probably some sideways movement. But I think in terms of the price action, I think is still okay for now. Price is still holding some higher lows along the way since 9 March. And then I think key support for now is around this 145, 146. There's some moving averages as well as horizontal level. So and then resistance for now 151. So some sideways movement. Above that will likely be around the next key level will be around 155 as well as 159. The next one on Franklin, I think for now likely to see some sideways movement. Price, I think just doing quite some sideways movement, holding support at 20 SMA around 204 right now after a retest of these 218 levels. So probably we're gonna see some sideways movement for now, I feel. And maybe waiting on the weekly time frame, maybe waiting for the 10-5 retest of the 10 SMA, which is like 199 right now. And for Singtel, also not much movement for now. So that's probably sideways consolidation still ongoing, which is in this current range of around 490 to $5.10. Yeah. Yeah, in terms of the weekly chart, it's still holding around the 10 SMA as a support as well. 499. The next one I'll touch on DBS. Yeah, for DBS, I think it's also a bit of a range consolidation. So some resistance for now is around this 57.90 to about $58.10 area. Positive is that price is still has been forming higher lows and also just recovering since since 9 March over here. So I think likely we will see some continued sideways movement, but holding higher lows with support, I think holding around 57.10, $57.10 to about 57.40. Yeah, then afterwards, if can break above $58.10, the next level will be around $58.80. Yeah, so I think overall still some gradual recovery taking place for DBS. And for Sheng Siong, I think some still continue on the momentum right now. So I think for now, we're likely to see a retest of this 297 swing high form in early February this year, I think. And then subsequently, we might see some slight pullback or consolidation afterwards. Yeah. So as long as it stays above the 5-day SMA for now, I think it is still continuing the strong momentum. We're still seeing higher highs on the daily level. For prop next, I think still a bit of nothing too much, still a bit of a sideways movement. The key resistance still around 175. Yeah, on the weekly time frame also holding around the 5 SMA weekly. And then the next key resistance might be when we retest the 10 SMA weekly, like around 188, right? So 175, if it's quite important. If you can break above that, I think we could do some slight further recovery towards about 183 to 185 area. Next one on CATL and Zijin Gold Mining. Yeah, for CATL, I think just some site still very much a very narrow consolidation. So this the previous support around like 650 still holding as resistance, and price is holding 614 over here as a support. So just very tight movement over here. And I think on the weekly time frame, we still like to see this 5 SMA hold as support, which is around 618, 619 right now. So I think we could see some slight rebound. I think if it breaks above 650, then the next resistance around 670 to 685. And then for Zijin Mining, I think right now it's just some sideways consolidation, some resistance coming from the 20 SMA as well as this swing high around 3660. And then, but I think support will hold at 34 to about 3480, this area over here where there's the 5 and 10 SMAs as well as the horizontal levels. So probably some sideways movement for now. Yeah. Okay, then I'll take some more questions. CSE Global Micromechanics as well as Valleytronics. Okay, for CSE Global last week retested this swing low over here, 116, and then still forming a bit of lower highs, mainly finding resistance from this short-term downwards trend line over here, as well as the 10 SMA, which is like 121 right now. So this is a resistance right now, 121, 122. Another retest of this swing low support, 116 today. So still some weakness overall. I think 116 needs to hold. If not, we like to see possibly a breakdown towards 109 as the next key support level. Yeah, then 122 still remains as a strong resistance. So very sideways movement, right? And next one, Micromechanics. I think it's still very strong momentum. So price is still forming some higher highs as of last Wednesday, and price still maintaining above the 5 SMA, currently 239. So it hit about 250 resistance, some slight resistance over there. I think as long as price generally remains above 234 to 230 area, I think the momentum could still continue. And the next possible resistance could be around 259 next year. And then for Valuetronics, Valuetronics, a bit of a sideways movement, generally with some key resistance still holding around generally around the 92 cents level. And price, I think, but some positive price action is that we're still seeing some higher lows generally along the way. I think support will likely hold around the 90 cents level over here. So possibly some sideways movement over here. But then if you can hold a range over here, I think there could be a chance of break above this 92 cents eventually. I think that's all. I think it's about one. So I think there's still some questions in the Q&A. Sorry, I'm unable to take all of them. But feel free to post in our Poems Tree community, and I will continue over there. Yeah, I'll hand over time over back to Paul. You have anything to add on?
Nothing. You can just close it. Yeah. Thanks.
Yeah. Okay. So thanks everyone for joining our morning call today, and thanks for all your questions as well. If you have any more questions that we have, if we didn't have enough time to answer, please feel free to post them in our Poems Tree community. And also, if you have time, feel free to join our Corporate Insights webinar on CNMC this week, as well as our second quarter Singapore strategy event taking place this Saturday. Yeah, so thanks everyone, and have a good week ahead. Hope to see you again next week. Bye bye.